with chaos at the New York Stock Exchange.
Get back in there at once and sell! Sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Thursday, June 18th, 2026. Markets closed on Friday for the holiday, so we're coming at you a little early this week. Some big shout outs to Sandy and Dan, Jeff, Joy, all the folks tuning in week in, week out. We really do appreciate it. Thanks for keeping up with us and keeping up with what's going on with your money. Hey, so what happened with the market this week? Let's just jump into it. And let me tell you, markets had a constructive week this week. The Dow Jones up 0.71% this week. The S&P 500 up 0.93%. The NASDAQ Composite up 2.4%. And the Russell Small Cap Index up 1.2% on the week. The Volatility Index, as you might expect, down about 7% this week, finishing at 16.5%. Coming down a little bit this week with some of this market pushing higher. We had long-term bonds as measured by the TLT up 1.1% this week. Long-term rates drifting a little bit lower. And that's kind of interesting, honestly, given some of the news items that we had this week. And we take a look at all of the different sectors out there, really the most aggressive areas of the market doing the best. Things like semiconductors up 6%, drive and technology up 3.5%. Industrials are up 2.6%. Of course, they're the ones building all these AI data centers. And everything else was pretty sloppy. The real conservative defensive areas were the worst. Staples are down 2.9%. Healthcare down 2.9%. Energy, of course, getting hit, down 6.5%. I'll tell you why in a moment. Kind of sloppy on the sectors, but the market did push higher. The growth stocks, and especially the semiconductors, the AI trade, really pushing things higher this week, really taking things to another level. And then taking a look at gold and silver. Gold flat on the week, silver down 2.9%. What moved markets this week? Really two big stories. The first one was a Memorandum of Understanding, an MOU, signed between the United States and Iran. In essence, it's an agreement to negotiate, okay? An agreement to negotiate. But the good news is hostilities have ceased. And oil is moving through the Strait of Hormuz, along with helium, along with fertilizer, along with all the other things that are stuck up in there and can't get out into the marketplace. So the market responded positively to that. But look, there's a lot of wood to chop there, a whole lot. Market really responded initially with a big move higher, but then it kind of got jammed up a little bit here midweek. We'll talk about why on that in a minute as well. But getting back to Iran and the U.S., as I mentioned, a lot of wood to chop. I think that there's still risk in front of us in that regard. And listen, oil, although it pulled back this week, didn't pull back as much as you might expect. The energy sector is still up 20% on the year, one of the best performing sectors in the market. And as I've mentioned time and time again, there is a structural challenge in oil. Look, we're down to the lowest reserves for the strategic oil reserves for our country. We're down to the lowest levels we've been at in decades. And I mentioned last week about Cushing, Oklahoma, the heartbeat of oil and energy in our country down to record low levels. It's a problem, right? And can this oil come online fast enough to keep prices from getting squeezed and pushed higher when there's a supply and demand issue? We will see. Right now, the market's looking through it. I'm not sure if that's the correct call, but we'll see how it shakes out. Look, we've got some energy exposure. We trimmed it a few weeks back, you might recall. We still have exposure there. I think that's cheap no matter how you look at it right now. And it's probably going to be pretty constructive no matter how all this stuff shakes out, because there's a supply and demand issue moving forward, and it could be a pretty intense one here in the next few weeks. The other big story that moved the markets this week was Mr. Kevin Warsh, the new sheriff in town for the Federal Reserve, had their first meeting, and the game is changing, folks, and it's changing in a major way. Kevin Warsh is taking a page out of Alan Greenspan's playbook. Alan Greenspan, great Fed chief back in the day. And Kevin Warsh is taking a page out of his playbook, meaning that he's not going to tell you anything. Okay, look, Alan Greenspan, he was incredibly proud of these two newspaper articles hanging on his wall. They were both front page stories from two major newspapers. One said the Fed pivots dovish, and the other one says the Fed pivots hawkish, right? And they were both taken from the same exact press conference. That's what he was into, not indicating anything. And guess what? Kevin Warsh did the same thing this week. Now, the market initially took the meeting as negative because half of the board members were indicating that they expect rate hikes by the end of the year. 9 out of 18 that voted were expecting rate hikes by the end of the year. Market didn't like it. Market really came down hard on the Fed announcement day. But it seemed to calm down a little bit today because when you really listen to everything this guy said, you could take it positive or negative. On one hand, he really pounded the table on affordability, trying to fix inflation, trying to tame inflation, and really made it sound like, that was the number one objective above and beyond all things, was getting prices stabilized. Then on the other hand, he says he's only paying attention to the left hand of the decimal point when it comes to the inflation number. Well, the Fed's goal is 2%. If you're only going to pay attention to the left-hand side of the decimal point, it sounds like you're okay with 2.99. And we're not too far away from that. So very interesting take on it all. And look, it changes things up for us. For the last 25 years, I haven't had to think too much about the Fed because they do all the thinking and put it all out there for you to hear and know what they're going to do next. They telegraph everything. They do all this forecasting. They telegraph what they plan to do. They leak stuff to the press right before the blackout period if things are changing. You've heard me talk about all these things. We've been doing this podcast since 2019. It's just really easy to call the Fed because they pretty much call it for you. And I regurgitate what I think they're going to do usually based off what they say. It's not that hard. It's not that much rocket science involved. That said, now things are changing. They're changing in a major way because they're not going to be indicating. They're not going to be telegraphing. And we're going to have to kind of change how we do things. So I sought out the top dog, the number one Fed pontificator, the one that has had the most accurate calls over history and has Alan Greenspan experience. He called Alan Greenspan's calls correctly over and over and over again. I'm not going to say who he is. We got competition that listens. Let them do their own homework. But I tracked him down and we entered an agreement. As you know, we work with some of the top fundamental analysts, macro analysts, technical analysts in the world, folks. And now we have the top Fed watcher, I would say, in the world. And we're going to be getting his insights moving forward because what we want to do now is have somebody parse through all of the economic data, think like this current Fed chair, and then give us some heads up as to where things might go at the next Fed meeting and the meetings to come. So that's what we've done. And I'm looking forward to getting that research moving forward so we can kind of stay one step ahead of our competition, other folks that are out there trying to do this job, because it's not an easy job to do. And now we've got another wrinkle thrown in there with a Fed chair that's not going to say anything. And look, I don't mind that. I actually think it's a good idea. I think the Fed's stupid most of the time. Most of their forecasts are dead wrong. Most of the directions they say they're going to go, they have to change. It's really a mess. And it has been for 25 years. And I think it's best if they say less, let the data speak, react to the data. When you put a forecast out there, the market's going to react to the forecast. The market is going to move big time if you indicate that you think that you might cut rates in the future, 6 weeks or whatever the case may be. Things can change. And then when things change, the market has these nasty reactions to it. So look, I think it's best just keep your mouth shut, examine the data, make the call. Now, what does that mean? It means there's going to be more volatility around Fed day, but I think there's going to be less volatility between Fed meetings because the market's not going to be getting faked out and moving off of false signals moving forward. And I think that's a pretty good thing overall. So look, that's what I've got for you this week. A lot going on. Good things, right? We'll see if things continue to resolve with Iran. Economic data was mixed. Housing starts were horrific. Housing market's getting beaten up. Kevin Warsh mentioned that too. Keep your eyes out for something they might do there, folks. They may do something like an Operation Twist. They might do something to try to bring down these long-term rates to try to get this housing market moving again. He seemed to be pretty focused on that. We'll see. I have no idea what their plans are, but I know that housing's getting hammered. Other areas of the economy are looking okay. Consumers hanging in there. So right now, we're going to keep doing what we're doing. Right now, it's doing great. So we're happy with how things have gone, and we'll just continue sticking to our positioning, staying very disciplined and diversified. I think that's the right call right now in this market. So between now and next few meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it is buy that classic car and restore it in your brand new pole building with all of the beautiful Snap-on tools and the air compressor and the lift. I'm jealous of you guys that have the lifts. I really am. I just think that is so nice. Anyway, hey, don't just think about it. Think big. Think BIG, and I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.